Probably already heard about fair value gaps, imbalances, or even BISI and SIBI. These concepts have become very popular in smart money trading, and for a good reason. When used correctly, they help you identify the zones where institutions left their footprint in the market. But today, the real problem isn't knowing these terms. The real problem is knowing which fair value gaps are actually worth trading and which ones you should ignore. Because not all fair value gaps work. Some get broken immediately. Others show no reaction at all. And only a few provide clean and highly profitable entries. The difference between a losing trader and a consistent trader is the ability to filter the right setups. In this video, I'm going to show you what an imbalance and a fair value gap really are, quickly and clearly. The difference between BISI and SIBI to understand the direction of the imbalance. 7 professional techniques to identify a valid fair value gap. And finally, a powerful strategy to trade these zones like institutional traders. Because yes, fair value gaps are extremely powerful, but only if you know how to recognize high probability zones. If you want to improve your precision in trading, avoid false signals, and enter at the right moment, make sure you watch this video until the end. Before talking about the 5 ways to identify a valid fair value gap and the strategy, we first need to understand the basics. In smart money trading, an imbalance simply means a mismatch between buyers and sellers. It's a situation where price moves so fast in one direction that the market doesn't have time to trade properly at certain levels. In other words, some price levels are skipped. The market becomes inefficient and often looks to return to those zones later. That's where the fair value gap comes in. A fair value gap, or FVG, is a specific type of imbalance. It usually appears across 3 candles. When a strong impulse happens, the middle candle creates a space between the wick of the first candle and the wick of the third candle. That space represents the market imbalance. We assume price may return to that zone to rebalance orders before continuing in its original direction. In summary, imbalance equals a general market imbalance. Fair value gap equals a precise imbalance visible on the chart. And in smart money trading, these zones are used to look for high probability entries. Now that we understand imbalances and fair value gaps, let's talk about BISI and SIBI. These terms come from ICT trading, and they simply describe the direction of the imbalance. BISI means buy-side imbalance, sell-side inefficiency. It's a bullish imbalance. Buyers dominate, price moves up fast, and leaves a fair value gap below. Smart money traders look for buys when price returns to that zone. SIBI means sell-side imbalance, buy-side inefficiency. It's a bearish imbalance. Sellers dominate, price drops fast, and leaves a fair value gap above. Traders look for sells when price returns to that area. In short, BISI equals bullish fair value gap, SIBI equals bearish fair value gap. Understanding this helps us trade in the right direction. Now that we understand the basics, let's look at how to recognize a truly valid fair value gap. Because not all fair value gaps are equal. Some give clean entries, others simply don't work. Here are 7 professional techniques to filter the best setups. 1. The fair value gap must appear after a strong move. A fair value gap created after a violent impulse has a much higher chance of being respected. Why? Because a fast move usually means institutions were heavily involved in the market. When you compare 2 fair value gaps, the one created by a strong move is often respected. The one created by a weak move may be ignored. So always prioritize gaps that come after a clear and aggressive impulse. 2. The first candle must sweep liquidity. A strong fair value gap often begins with a liquidity sweep. This means price breaks a previous high or low, quickly re-enters, then closes back inside the previous range. This sweep traps retail traders and allows institutions to enter positions. Fair value gaps that follow a liquidity sweep have much better probabilities. 3. The third candle should slow down or range. A fair value gap is formed by 3 candles. When the third candle slows down, consolidates, or ranges after the strong impulse, it often shows the market is preparing a retracement. In this case, there is a strong probability that price will return to test the fair value gap. 4. The fair value gap must be unmitigated. A valid fair value gap must not have been tested already. If price immediately comes back into the zone and leaves, the gap is already mitigated. Its probability drops significantly. A strong fair value gap should be untouched. 5. The fair value gap should have confluences. The more confluence you have, the stronger the gap. For example, support or resistance, market structure, institutional zones, nearby liquidity. Support inside a bullish fair value gap strengthens the setup. Resistance inside a bearish gap does the same. 6. The fair value gap should follow a break of structure. Before the fair value gap, we want a break of structure. For buys, price breaks a previous high. For sells, price breaks a previous low. This shows that the trend is changing or confirming. Without a break of structure, the fair value gap is less reliable. 7. Prioritize fair value gaps on higher time frames. Fair value gaps on higher time frames are more powerful because they represent areas where institutions truly acted. A fair value gap on 4, daily, or weekly has much more weight than one on 1 or 5. Then you can refine your entry on lower time frames. Valid fair value gap complete trade example. Here's how to combine these rules. A fair value gap appears after a liquidity sweep followed by a break of structure. The gap is unmitigated, it sits inside a support zone, and it's visible on a higher time frame. In this case, we wait for price to return into the zone. We watch the candle reaction, then enter with a stop below structure and a take profit toward the next liquidity level. This is exactly how smart money traders exploit fair value gaps. Conclusion. Fair value gaps are powerful, but only if you know how to filter the right ones. By applying these 7 techniques, you will avoid bad setups, improve your precision, enter high probability zones. And in the next part, we'll go step by step through the full strategy to trade fair value gaps like a professional. And finally, a powerful strategy to trade these zones like institutional traders. Because identifying a fair value gap is only the first step. The real edge comes from knowing when to enter, where to place your stop, and where institutions are targeting liquidity. So, how do we enter trades? Here are 3 practical strategies to trade fair value gaps. First, entry after a rejection. When price enters the fair value gap and then closes outside the zone in the opposite direction, you can enter right after that candle closes. Why? Because it shows a clear rejection. It means the market respects the fair value gap and a move is likely. Place your stop below structure and target the next liquidity level. Second, entry with an institutional zone. If the fair value gap is near an order block or a supply and demand zone, Wait for price to return into that zone first, then look for confirmation on a lower time frame. A small break of structure, a rejection candle, or a liquidity sweep. This combination greatly increases probability. Third, entry at the 50% retracement. If the fair value gap does not reject immediately and there is no institutional zone, wait for price to retrace about 50% of the fair value gap. This midpoint often acts like equilibrium. At that point, look for confirmation before entering. Watch candle reaction, microstructure breaks, or liquidity sweeps. In this strategy, you learn to wait for price to return into a high probability fair value gap. You confirm with market structure, enter with precision, and manage the trade like a professional. This approach removes emotional trading, reduces bad entries, and keeps you focused on high probability setups. Because fair value gaps are powerful, but only if you know when and how to trade them. Now, you understand how to recognize a valid fair value gap and how to trade it like an institutional trader. But remember, fair value gaps are only powerful if you apply discipline. Wait for the right setup, confirm with market structure, and manage your risk properly. If you practice these principles, your trading precision will improve. If this video helped you, leave a like, subscribe, and share it with another trader who needs it. See you in the next video.